Hello, and thanks for joining our Diversified Large Cap webinar. My name is Matt Agnes. I'm a Managing Director and Head of the Client Portfolio Management Group at Barrow Hanley Global Investors. I'm joined by Mark Giambrone. Mark is a Senior Managing Director and Portfolio Manager on the Diversified Large Cap Value Strategy. Welcome, Mark.
Thanks, Matt.
Just a couple of housekeeping items. Today's webinar is going to be recorded and distributed in a few days. And secondly, we'll be taking questions at the end. If you have questions, click on the Q&A icon at the bottom of your screen. We'd like to talk about three things today: portfolio performance and its drivers, portfolio positioning, secondly, and our outlook. But before I do that, I'd like to just set the stage for that discussion by talking about the team, the investment strategy, and then Mark will talk about process before we get into performance, drivers, positioning, and outlook. So let me share my screen. I'll give it a second here. Mark, can you see that?
Yes, I can. Thank you.
Okay, great. Well, this is the team. Diversified Large Cap Value Strategy is managed by Mark, of course, and Terry Pelzel and Michael Nafa. Mark is lead portfolio manager and has been a portfolio manager on the strategy since its inception in 2000. And the team is supported by our global research platform. When it comes to evaluating a money manager, it's really about the 5 Ps: philosophy, process, people, portfolio, all of which are leading indicators of performance. So philosophically, the first P, philosophically, we believe that markets are inefficient and best exploited by a valuation and dividend-centric investment process. The second P, process. Mark will go a little bit more in detail about the process, but I would start by saying it's well-defined, consistently applied, and repeatable by a seasoned portfolio management team, the people being the third P. The PM team has managed strategy through multiple market cycles, resulting in a portfolio that has high active share relative to the Russell 1000 value. And the output of that philosophy, process, people portfolio has been performance. The team endeavors to outperform the Russell 1000 value over a market cycle, which I'm happy to say we've achieved and are at the upper end of that range, again, since the strategy's inception 22 years ago. With that, I will turn it over to Mark and circle back in a bit. Mark?
Thank you, Matt. Before we talk specifically about this page, let me just speak more on a high level to say that we look for good companies down for reasons we can identify and believe are temporary, while we adhere to our long-standing value philosophy. What does it mean for us to be traditional value? We're going to have true value characteristics in the portfolio. As Matt suggested, having a consistent team, process, philosophy puts us squarely in the value boxes over time. And one of the ways to demonstrate that is to look at some value characteristics, which we show on the upper portion of this page. So there are a lot of ways to measure value. In this particular case, we're looking at price to earnings, price to book, enterprise value to EBITDA. And you can see that we have a significant discount in those 3 ways in the portfolio relative to the market. We also believe that yield is critically important for both a value manager and for overall returns in the portfolio. And so we have consistently a meaningful dividend premium to that of the market. But when I say good companies, it's another thing that's hard to directly identify. So we know we want to have good value, that's demonstrated by the upper portion, and we know we want to have higher quality businesses, but that have stumbled. and that through the 33 experts that we have on our research team, through our deep knowledge of the industry and the sectors and the companies, through talking to management, through doing what we consider blocking and tackling in our due diligence. So talking to suppliers, talking to competitors, again, understanding market dynamics. We're going to then be able to think about prospectively, what will the future of this company look like? And how will that relate to growth rates and returns that the market can then look at for valuation? So on the bottom portion of this page, we talk about if we're good companies, but down for reasons we can identify and believe are temporary, then as those abate, the performance of that business should improve. And that performance we try to demonstrate through earnings growth. So in this case, we have a meaningful premium to earnings growth. We have nice levels of return. We have a dividend payout ratio or reinvestment rate that's really meant to demonstrate that the company creates lots of free cash flow, more than that of the average business. And so they can pay us a meaningful dividend while still having plenty of cash left over to reinvest in the business and to drive returns going forward. And that generally leads us to companies with better balance sheets. So we believe that this process and philosophy will work over time to drive alpha in the portfolio, really through a combination of those two boxes. So now if we move to the right-hand portion of this slide, it talks about, if you start out with a group of companies that have a valuation discount to the market, and you add that, right, to companies that have on a prospective basis above average quality, that should lead to a portfolio that outperforms. The next page is the performance. And as Matt suggested, we'll get to the attribution in a moment. So this is really a snapshot of kind of the 1 and 3 year. One of the things I did not mention is we do tend to have low turnover. We do have to have a 3 to 4 year time horizon. So for us, that's the longer we look at this, the better. So our 1 year, our 3 year, our 5 years, we move forward 10. And I actually have been here since inception. So again, these numbers matter if you have the same team, process, and philosophy in place, and we feel good about where we are. We'll talk a little bit later about why we think that may continue.
If I could interject, Mark, I would say value has moved in fits and starts, but one of the inflection points that you can point to is November of 2020. The portfolio has returned an annualized just under 15%, so 14.96% on a gross of fees basis versus 9.39% for the Russell 1000 value. So more than a 560 basis point annualized performance advantage. And that's put us in the top quartile, around the top quartile relative to our peers. What I think that means to you is it illustrates that this strategy has no style drift, and it's exposed some of our peers that have drifted. And meanwhile, the strategy is being rewarded with that top quartile performance. So when value does well, we tend to do well.
Thanks, Matt. I'll refer to that in a little later in the presentation. Thanks for setting the stage there. And then if we can just talk about attribution for a moment. Again, this is the 1 year attribution. Since we're bottoms up stock selectors, the output of the sectors are really just an input, right, or an output of our individual stock selection bottoms up. What I'm pleased when I look at this chart is, again, on a 1 year basis, the vast majority of the outperformance has come through selection and interaction. That's what having a high quality 33-person team should lead to. And we believe that active and value is clearly where the market is headed, and it is where our strengths are. If we move to the 3 year, you'll see something very similar, where again, we've outperformed nicely, and most of that outperformance comes from selection and interaction. We can answer more questions about this later if there are any. If we move to the portfolio next, again, I think what's important about the portfolio is just to know that it's an active portfolio, picked one stock at a time. It is our expectation to be different than that of the benchmark. It is our expectation to have high active share, high conviction weighting, and if we can't be different, we can't win. So if you kind of just look at some of the sectors, consumer communication services is a good example. We're about half the weight. consumer discretionary, we're meaningfully overweight, consumer staples, we're meaningfully underweight, et cetera. So as you look through those portfolios, you'll see where we're finding value is then reflected into where our overweights are, and where we're not is, reflected in our underweights.
We'd be remiss if we didn't have at least one chart or a couple charts on here on value versus growth. And let me just walk you through what we were trying to illustrate here. We've taken 25 years of monthly rolling data and plotted the valuation disparity of value versus growth and quantified that, and then looked at the subsequent 5-year annualized performance of value versus growth, and drew a regression line, a line of best fit. So you can see 240 data points and this line of best fit, and where today's 41% discount of value relative to growth lines up. So if you draw that dashed line up to the line of best fit and over to the subsequent 5-year annualized outperformance of value over growth, you get a number of something in the neighborhood of 5.4% annualized outperformance of value over growth over the next 5 years. I think the other point that's worth mentioning is that, in this cluster of data, which are all about the same discount as we are today, there are a number of data points where the subsequent 5-year outperformance of value over growth has been, 6, 7, 8, 9, almost 10%. So the valuation disparity of value versus growth today bodes well for value in the future. With that, I'll turn it over to you, Mark, on the next page. Yep.
Yeah. Thanks, Matt. I think, to me, this slide is where I get really excited about what the future looks like for the Barrow Hanley portfolios. And as Matt mentioned, whether you want to use November of 2020 as the turn where active and value really mattered, I think it's fair to say that we're early in a value cycle. You see, we put that star on the upper left-hand portion as to kind of where we think we are, around 24 months. Of course, that's difficult to gauge, but the point is that when a value run begins, based on history, it lasts about 7 years. There is significant outperformance from value, and when that tends to happen, the bottom right-hand portion, which was the last time from 2000 to 2007, we had a similar period. And I can argue there are many similarities between the tech bubble and kind of what happened coming out of the COVID / very long growth cycle that the market was in the 2020 period. Value again does well. That's the black line, performance over 73% there. And you can see the Barrow Hanley return of the portfolios was more than double that, or 147% premium return over that of the market. And so this tells me that we have the same team, we have the same process and philosophy. We're in a very similar starting point in terms of a value run versus growth. And I think this will bode well. And as Matt suggested, in the 2-year period that's already begun, that's starting to unfold. And I think we have multiple years of this type of performance in front of us.
Thanks, Mark. Just a reminder, if you have a question, click the Q&A icon at the bottom of your screen, and we will answer those questions. We do have a question about the portfolio positioning, so let me flip back to that page. The question, if I could paraphrase, is it looks like you've eliminated some lenders, Citigroup, Discover, JP Morgan, SLM Corp. Could you give us your thoughts on that, Mark, your thinking?
Sure. When we get into a cycle, so financials are obviously a very large component of the value benchmarks. You can see it's the largest weight in the Russell 1000 value at 20%. We have a meaningful weight. So I want to start off by saying we have a meaningful weight, but within the financial sector. We think we're focused on the areas with the most value, and again, the highest potential returns versus where we've been historically. So in the environment we believe we're going into, rates are obviously rising meaningfully. The market is coming down. The economy is slowing. Credit may worsen. Financial transactions will lessen. So what we wanted to move away from were companies that were focused on areas that either were necessary for either level of the market or the transaction level of the market, or growth in GDP, to really drive those things forward. So if that's JP Morgan or Goldman, as you suggested, Matt, they clearly have a large component of their business focused on that. And what we wanted to do is move to businesses where we knew there was real strength, either in a benefit from rising rates. So in a rising rate environment, net interest margins tend to expand. And for different financial institutions, that matters to a different degree. And so in focusing on an M&T Bank or US Bancorp, where the lending or being a large S&L is a significant portion of their business, they were in a position to benefit from that. And on top of it, going with companies like that have historically been excellent underwriters, they will also be less impacted by a weakening credit environment as we go forward. We also think that if you move to the insurance markets for a moment, that there is significant strength there. The names are inexpensive relative to book and returns, and yet we're seeing, unfortunately, we're all seeing a rise in prices, but a consistent ability to raise prices in terms of risk in those areas. And so we're heavy related to those areas of the market where, again, we think have the best way to benefit from rising earnings and cash flows in the future, even in an uncertain environment. So while we have a meaningful weight, we're very different than that of the weight of the benchmark. And we moved away from what I'll call credit sensitive, market driven type earnings and more to net interest margin, excellent underwriting, and insurance rate growth over that period of time.
Looks like we have another question about consumer staples. Again, I'll paraphrase, but earlier you mentioned the portfolio is built on stock by stock basis, bottom up, without the residual sector weights, or sector weights are rather residual of your bottom up stock selection. Are you simply just not finding value in consumer staples?
Consumer staples are a group with generally speaking, very high quality businesses. So from that perspective, they're generally pretty stable. They have good brands. They have good pricing power. For that reason, especially as we look back into the last multiple years, and we went into this COVID shutdown, those particular type of businesses were prized very significantly. So the valuations there rose meaningfully. While the sector is generally a little more expensive, it really had a huge pull forward and a push in valuation really over the last several years. And so for us, we like those companies. We would like to own them at the right price, but it's just difficult at the moment because their relative values are so extreme in our mind, and the pull forward in terms of demand that we're seeing, that we just don't find a lot of value there at the moment.
Another question about energy, very topical with the Biden administration floating the idea of a windfall profits tax. Maybe your thoughts on the likelihood, or if that's just posturing, and maybe some comments on on the positioning in energy.
During an election cycle, which we're in now, lots of things are said that causes rhetoric and sometimes impacts the stocks also for a short period of time, related to what's happening in Washington. You really have to sort of think through those things or think past them to make sure that you don't have any short-term reactions. I view it as unlikely that would happen. And so from that perspective, I just view it as rhetoric. I think it's unlikely. In saying that, the energy sector is truly booming. And it's booming for multiple reasons, though. One, of course, is the conflict between the Ukraine and Russia has impacted supply. Russia is about 10% of the world supply. There's significant underinvestment happening there right now. There are sanctions. there are things that are going to have a very long-term negative impact on the supply side. In the US, we have had a focus on returns, we've had a focus on capital, we've had a pullback on the ability to find permits. And so I would argue we're underinvesting also in the US, another impact on supply. And then if you think about demand, there's clearly some impact to demand as the world slows. But because of the zero COVID policy in China right now, we have one of the largest consumers under consuming at the moment. So when we think about the offsets, the likelihood of the prices staying high, unfortunately, are more likely than not. And we think supply has a real problem, and therefore prices will stay higher unless demand comes down meaningfully, which we don't see. And we think these companies are in an excellent position to earn high levels of returns as we go forward. So we like the names that we have a lot, and we think we're well positioned in the names that we have to outperform not just the market but the sector itself.
Another question, again, I'll paraphrase, but you've talked about financials where you're underweight and sort of underweight lenders, overweight insurers, underweight staples. Maybe let's talk about a sector where you're overweight, that being industrials. Maybe some comments around, and a couple of new names in the industrial sectors as well.
Sure. The industrial sector is an outstanding sector to find value. It's one of the least homogeneous sectors out there because companies can be very different. I mean, if we just take the Deere, I think most people know what Deere is. It's a large agricultural, manufacturer of equipment, etc. And then the one right below it is Raytheon, which is a large, defense governmental contractor. And then you have J.B. Hunt, which is a large trucking and distribution company. So those three almost have no overlap in terms of what the end markets may look like or where the value could be. That's what makes it so exciting for an individual stock selection. So we like these businesses because normally they're high quality. They have good brands. I'm sure we've seen the J.B. Hunt trucks around, just like you've seen the Deere equipment around. Good brands and good cash flow lead to innovation that perpetuates their ability to take share. So with a brand and with innovation and an ability to take share, that leads to better pricing than the overall market. It leads to good cash flows. It leads to more stability through more difficult environments, and generally, therefore, can lead to earnings growth and PE expansion over time. So the industrial sector is an area that, again, if you understand the businesses really well with a broad team that can attack and understand all the end markets and individual companies that will benefit from different pockets of growth related to those valuations, we find that to be a very fruitful sector to find a lot of good opportunities.
Maybe one last question that's topical around technology with Facebook/Meta missing expectations, Amazon not in technology, but a bellwether, and Google, for example, missing. How is your tech positioning? Internally we've talked about it being old tech as opposed to new tech. Maybe just your thoughts on positioning it in technology.
Sure. So let me start off by saying that many of the companies that we're talking about are high quality businesses. Google is a good example. However, just because you're a high quality business doesn't mean you should have extreme valuations that don't make a lot of sense under a current environment. With rising rates, with the lower liquidity, multiples are coming down in the market. And the best companies, even in that scenario, are not immune to that. In addition to the fact that there is some cyclicality to these companies now, and capital allocation matters. So that's some of the issues I'd say are facing Google and facing Facebook, in addition to starting with very high valuations to begin with. With our group within information technology, we believe, again, are good companies, down for reasons we can identify and believe are temporary, or that are just simply mispriced based on the opportunities in front of them. So, let's take Oracle just as a simple example. Oracle, as we know, dominates So you need more and more data all the time, and you need to store it. So Oracle dominates in that particular market, but it's a very slow growth. It generates a lot of cash, and it's a very low multiple name. We like that portion of the business a lot because it gives us good stability. What people may be underappreciating at the moment is Oracle is growing a cloud. Cloud is becoming a very important place to put things, to store things. And Oracle has built out over the last several years an excellent offering to sell across its customer base, to continue to take share and deepen its relationships, to find pricing power, and to grow that particular segment of the market, which is indeed growing at a meaningful clip, but is relatively small to the overall business at the moment. But we think as you look forward, will be significantly higher and will drive the market to up the growth rates and therefore up to multiple over time. So we have a very stable business. We like the cash flows. They're allocating the capital appropriately into a higher, faster growing, more valuable market. And we think that's just beginning. As that continues to play out, we will see the earnings and multiple for Oracle rise, and we'll be in an excellent position, to capture good value there. So again, each name is a little different, but we want to find high quality companies undervalued with opportunity sets that the market isn't paying for. And technology is a good place for that. It's just that we believe some of the names and some of the ones you mentioned, let's call them the historical fangs, got ahead of themselves, and the current environment are too highly valued to find attractive at the moment.
Well, thanks, Mark. We're at the bottom of the hour and no more questions in the queue. So we would thank you for your interest. And if you're a client, thank you for your partnership. And if you're kicking the tires on the strategy, happy to speak offline in more depth. So appreciate your participation, and everybody have a good rest of the day.